Hi everyone, let's have a look at my low time frame and micro preferred and alternative bullish and bearish Elliott Wave scenarios on Bitcoin. Starting with the low time frame very bullish scenario, which is an alternative where this is a wave 1 followed by a 5, 3 and another 5 zigzag move in then wave 2, which is also the most common corrective pattern in a wave 2 for then a bigger 3 to the upside. The main reason, however, this is for me an alternative scenario has to do with this wave 1. It is very difficult, very complex to count a nice 5-wave structure in this wave 1. I did achieve it, which you can find in some older videos, but because of the clutter I removed it. Nonetheless, a 3-wave structure looks much better in this particular wave to the upside. However, in the very bullish scenario, this has to be a wave 1, followed then by this to be a wave 2, ending at the golden pocket taken from the low to the high of wave 1, which is the most common target area for wave 2 over here, for then now expecting a wave 3 to the upside. And if this is going to be a big wave 3 to the upside, you definitely want to see volume moving to the upside as well. Now, of course, we have a bit of a volume spike over here, but that doesn't really count in looking for a big wave 3 to the upside, because we want to see price moving to the upside and volume increasing. And this was basically just because of the news hitting just now, where we had Powell speaking at 5 p.m. Central East European time, which is basically the cause for this volatility on the chart. If we then go to the very bearish scenario, we have basically a 3-wave corrective structure and then an ABC, which is the end for then an impulsive structure to the downside, where this is a wave 1 followed by an expanding flat in a wave 2, which is a more rare pattern in a wave 2, because as mentioned, a zigzag is more common, and then eventually we're expecting a wave 3 to the downside. Now, this scenario has a couple of problems in my opinion. The first is that this being a wave 2 over here doesn't really work, because if this is a wave 1, then another wave 2, this being a wave 3 and this being a wave 4, then this wave 4 retraced too high compared to this wave 2, because a wave 4 is not allowed to close candles above the 0.5, and if you go to the lower time frames, you'll actually see that it did, and also it hit the golden pocket, as you can see, which is not allowed really for a wave 4, as that is extremely rare. Now, you could potentially think, hey, this might then be a wave 1, 2 and then another 1, 2. However, in a 1-2-1-2 scenario, what I prefer to see if this is a wave 1 followed by a wave 2, the second wave 1 usually is lower than the first wave 1. So then you get a 1-2, 1-2, and then you get the bigger 3 to the downside, where then the second wave 1 is lower than the first wave 1. But that is then not the case. Of course, one might potentially move the wave 2 to the right side, right? Where now you, instead of wave 2 ending over here, you make it end over here. But then this structure doesn't really fit any of the corrective structures we know from an Elliott Wave point of view. So it doesn't make sense. It makes much more sense. This is a 3-wave up, 3-wave down, 5-wave move to the upside over here, which then ends right there. That makes the most sense for that corrective structure. So therefore, these are the reasons this is an alternative scenario. And then my preferred scenario on the lower time frame is that we still have upside to go, but in a corrective structure. So we have an ABC and then a bigger wave W, followed by a zigzag ABC, finishing wave X right around the daily naked point of control, as well as the most common target area for wave C, taken from the high of W to the low of A to then the high of wave B, which is between the 1 and the 1.236, which, as you can see, has been nicely respected. Bit of a wick below, but that's absolutely fine. We also had the daily naked point of control as confluence at 26.350, and then just now we wicked inside this target area again, but eventually we do expect a move to the upside, where the most common target area for wave Y is between the 1 and the 1.236, which is between 28.2k and 28.7k, taken from the low to the high of W to the low of this wave X. And you see that we do have some interesting highs at 28.3k, and the reason that these are quite interesting for maybe a liquidity grab and downside is because this was also a news event in the past week, or last week actually. So we had some news going on, price pushed to the upside during the news, a lot of absorption going on over here on the lower time frames, on the CVD basically, for then a push to the downside. So there must be some liquidity above these highs. However, we also have a target box just above the most common target area for wave Y, so it can be interesting to hit this target box as well for then a continuation to the downside. And the target box is between 28.9k and 29.2k. So basically in this scenario we're looking for upside. Now if we do look at this impulsive move to the downside, basically in the past couple of videos, even when price was still ranging over here, we were looking at this area for a bounce, and I also already explained volume and proof of support, because this move to the downside, it went down on pretty high volume, as you can see over here, and of course it is quite risky to immediately enter a trade over here around this target area, right? Now everyone has their own strategy, but personally I would also be looking for at least a little bit of proof of support. So whatever you want to see, maybe a change of market structure, maybe a move to the upside, a retracement and bullish divergences, which is actually something I'm going to show you in a second, because that happened. Whatever it is, like at least divergences on the CVD, maybe you use RSI, stochastic, whatever it is, volume, doesn't really matter. But at least some sort of confluence, some sort of proof of support for then a potential entry in your scenario where the stop loss can be safely below somewhere and you're looking for a move to the upside. Now this scenario is also called a double zigzag, which is a 535 in then a W, corrective structure in X, and then you're eventually expecting another 535 in a wave Y. There is a big difference between a wave Y and a wave 3, which I do like to highlight, because both this scenario is going to the upside, as well as the very bullish scenario of being a 1, 2 and then a 3. And the difference is the wave 3 versus a wave Y. So if this is going to be a wave 3, you want to see price moving impulsively. So basically the curvature of the price is going more and more vertical as price is progressing, while volume is doing exactly the same. You want to see volume following the price movement to the upside, while in a wave Y, price action is going to be more of a ranging structure, where usually you can do something like this, with then the high of wave Y ending at the high of the channel. And volume is going to be like normal, basically quite similar to the volume we have in wave W over here. So that's not very high. You don't expect it to increase a lot with a price looking like that, right? So that is something to take into account. Now, if we then go to the micro scenario, or the more like 15-minute scenario, we just had the news, Powell speaking, 5 p.m. We basically took the highs of the range, then we took the lows over here of the range as well. So we also, like in trading, we call that a Darth Maul pattern from Star Wars, where if you go to the 15-minute, you have like this, like, you know, his lightsaber, which had like lightsabers on both sides, if you know what I mean. If you ever watch Star Wars, that is. I feel like a geek here. But then you have basically a move to the upside, move to the downside. And I labeled it at the moment as this being a three-wave corrective structure in A, expanding flat in a wave B, hitting then the most common target area for a wave B, which is between the 1.236 and the 1.38, taken from the high to the low of wave A, for then an impulsive wave C to the downside. Now, because this is news, you have to take everything with a little bit of like a korreltje of sand, as we say in the Netherlands, which basically means like there's a news event, high volume, price moving impulsively. So you got like Elliott Wave sometimes goes a little bit out of the door, but this can be counted in a nice ABC structure, where then you don't expect this low to be taken, to be honest, which is then the low of this wave C in an ABC, but also the low of a wave 2 or a B, because this move to the upside can be counted in a 5-wave structure, for then a corrective 3-wave structure, and then eventually continuation to the upside. Now we do have quite a big wick over here, and I have no problem at all for price eventually coming to the downside to fill the wick and then range around this golden pocket over here, which is taken from the low to the high that we have at B. As it stands, it's taken, from the low over here to the high of wave A or wave 1, because that is the impulsive structure, and then the corrective structure ending at the golden pocket. So that could happen because, yeah, well, we took the high, we took the low. We can also just be ranging throughout the weekend in the middle because it's weekend, volume might be low. And if we go to the 5-minute chart, then this is the same range. We have the low over here on the left, and we have the news events, and you can see we have a higher low on price, but on the blue line we have a lower low on the CVD. And if I put my cursor like this on the blue line CVD on the left side, you can see on the right side that the CVD line wick below my horizontal cursor line. So that means a lower low on CVD, higher low on the price. But I prefer to seeing CVD divergences on a 15-minute chart, and on the 15-minute we did not yet have any bullish divergences. So what I would maybe prefer to see is, instead of price pushing to the upside, maybe move to the downside a little bit, go back to that golden pocket area, and then also show me some bullish divergences on the 15-minute. I think that would be pretty nice. Now, if we do zoom out, at least you can see we do have some bullish divergences on the 1 hour between the low over here and the higher low created on the CVD chart. Higher low in price, lower low on the CVD, bullish divergence with then a target at 27.6k. So I hope this video was helpful or valuable to you. Please check out the macro and the high time frame video if you're interested. And for now, thanks for watching and subscribing, and I will see you at the next one. Bye bye.